So, Apple has finally shown its hand. By 2026, John Ternus, a hardcore hardware engineer who's been at the company for 24 years, is set to be the next CEO. Now, this isn't just some executive shuffle. This is a massive public signal about Apple's entire capital allocation strategy for the age of AI.
And that brings up the big question that everyone in the market is wrestling with. Right when the entire tech world is obsessed with AI software and the cloud, why on earth would Apple hand the keys to its $4 trillion kingdom to a metal-bending hardware guy? It feels totally backward, but that's only if you misunderstand what game Apple is actually playing.
Let's be crystal clear. This is not a mistake. This is a deliberate, calculated move. What we're seeing is Apple publicly declaring that it refuses to get dragged into the ruinously expensive cloud AI war. Instead, they're choosing to fight a much more profitable war right on their home turf, the physical hardware that you hold in your hand. To really get this, you have to follow the money. It all comes down to one thing: avoiding a massive financial trap that could absolutely wreck Apple's legendary return on invested capital. Okay, look at the two playbooks here. On one side, you have the cloud AI war. From a financial perspective, this is a potential black hole. It's an asset-heavy nightmare of recurring costs. You have to keep building more and more data centers. That's your capital expenditure, your CapEx, and that cost just grows and grows as more people use your service. Apple's strategy with on-device AI is the polar opposite. It's asset-light. They take the cost of AI compute, they bake it right into the device's bill of materials, and you, the consumer, pay for it one time upfront when you buy the phone. Now, this on-device approach has huge advantages for you, the user, things like speed and privacy, because your data isn't being sent to a server halfway across the world. But for Apple's bottom line, it's even better. It means they avoid the crushing, endless expense of running massive server farms. And maybe even more importantly, they avoid the enormous liability and cost of storing petabytes of user data. So you see, privacy isn't just a marketing slogan for Apple, it's a core pillar of their financial strategy. It's a cost-saving fortress. So you might be asking, what happens when an AI task is just too big for your iPhone? Well, that's where their hybrid solution, Private Cloud Compute, or PCC, kicks in. But don't think for a second that this is Apple giving in and going to the cloud. From a capital allocation standpoint, PCC is a brilliantly designed CapEx shield. It's a very limited, highly secure system built on their own silicon, designed only to handle the overflow, preventing Apple from ever getting exposed to those runaway variable cloud costs. And here's exactly how that shield works. Because it runs on custom Apple silicon and hardened OS, the operational costs are kept super low. But the most critical part is that it's stateless. That's the key. It means your data is processed and then it's gone. It's instantly deleted. No long-term storage means no long-term costs, no long-term balance sheet liabilities. It's designed to be the exception, not the rule, which puts a hard cap on their expenses. So, by aggressively controlling the cost side of the equation, Apple can now focus on what it does best: maximizing profit. This on-device strategy isn't just a defensive financial move, it is an incredibly powerful engine for creating profit. Let's walk through their financial flywheel. Step 1. They build more powerful neural processing units, or NPUs, into their new chips. Okay, step 2. This makes the device more expensive to build, increasing the bill of materials. But then, step 3. Apple uses its incredible brand power to raise the average selling price, or ASP. They pass that higher cost plus a healthy margin right onto you. And what does that do? It creates a powerful incentive for a massive hardware upgrade cycle, turning what would have been a recurring server cost into a huge one-time, high-margin sale. And remember, this isn't just about the main chip. To run powerful AI on a device, you need a whole system overhaul. You need more RAM, you need a better battery, you need more advanced cooling systems. Every single one of those components adds to the device's cost. But crucially, it also gives Apple another concrete reason to justify a higher price tag for the whole package. But this entire elegant strategy, this beautiful financial machine, it all depends on one single critical factor: their ability to get their hands on the world's most advanced silicon. And right here, right now, the ground is literally shifting under Apple's feet. You're looking at a major power shift. For the first time in more than a decade, Apple is no longer the #1 customer for TSMC, the undisputed king of chip manufacturing. The insatiable demand for Nvidia's data center GPUs has pushed them to the top. Apple's long era of getting special treatment and first priority is over. And you have to understand, this isn't just about who has the most money. It's about pure physics. A single high-end NVIDIA GPU takes up 6 to 8 times more physical space on a silicon wafer than one iPhone chip. Think of it like real estate. There's only so much land on the most valuable lots, and TSMC's advanced production lines are completely booked. It is a zero-sum game.
So what's the financial fallout? It's immediate, and it is harsh. Apple is now staring down a price premium of roughly 50% for TSMC's next-generation 2-nanometer wafers. This is the single largest price jump in years, and it's a cost that's going to hit them directly in their gross margins, unless they try to pass that entire cost onto consumers.
Of course, Apple isn't just sitting there and taking it. They are making 3 big countermoves. First, they're finally diversifying, striking a new partnership with Intel. Second, they're leveraging their colossal size and cash pile to negotiate the best possible deals they can get. And third, they're signaling extreme confidence to Wall Street with another massive $110 billion share buyback. And this brings us right back to John Ternus, the man who has to navigate this incredibly complex new reality. What does his leadership philosophy, what we might call the Ternus Doctrine, tell us about Apple's future? Well, here's the quick profile. He's a mechanical engineer who spent his entire career at Apple. He's the guy who led the absolutely critical transition to Apple Silicon, and he already oversees the products that generate 80% of the company's revenue. You really couldn't find someone who better embodies this hardware-first, product-focused strategy. He is the strategy made manifest. And this quote right here, this is everything. This perfectly captures his doctrine. It's a marathon, not a sprint. Now, that's not just a nice soundbite. It is the core philosophical justification for a capital allocation strategy that says we will prioritize long-term, durable profits over chasing short-term AI hype. For him, technology should be seamless, integrated, and above all, profitable. But, and this is a big but, this marathon doctrine comes with huge risks. The biggest critique is that Ternus is a master refiner, but he's never launched a truly new product category from scratch. Then there's the cultural risk. Can a hardware-first culture really attract and keep the absolute best AI software engineers in the world? And the biggest danger of all, what if this marathon is actually a sprint, and Apple's slow and steady approach just leaves them hopelessly behind? Okay, let's put it all together. Time for the final business take, the bull case versus the bear case for this entire strategy. So here's the final breakdown. The bull case is simple. This is a stroke of genius to protect Apple's incredible return on capital by staying out of the CapEx war. It deepens their moat, and it plays perfectly to the strengths of their new CEO. The bear case is that the TSMC supply chain risk turns into their Achilles heel, that Ternus's patient incremental approach is just too slow for the pace of AI, and that their marathon turns into a race they are simply destined to lose. And that leaves us with the one question that matters. Is Apple's hardware-centric bet on AI a brilliant move of capital allocation that will protect its financial fortress for another decade? Or is it a fatal misread of where the real value of the AI revolution is actually going to be created? The answer to that is going to define the future of one of the most important companies in the world. Okay, that's my take. As always, this analysis is for educational purposes only. It is not investment advice. Please make sure you do your own research before making any financial decisions. Thanks for diving deep with me on this one.